The Bogleheads are a well-united group of investors. John Bogle, who preferred to go by Jack, is the honored figure of this investing group. He did more for everyday investors like you and me than anyone else in history. And I don't think that's hyperbole. He's at the top of my investing mountain, smiling alongside Warren Buffett, of course. I consider the general strategy used by the Bogleheads to be superior to nearly every other method of investing. I'm a borderline Boglehead myself, but I do have a bone to pick here in my first annual video to all Bogleheads. Let's do it. Before that, if you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your net worth with simple, time-tested solutions. If you enjoy videos like this one, please smash that like button, subscribe if you haven't already, and drop me a comment below with your thoughts. I would especially love to hear from the Bogleheads on this one. Let's grow. The Boglehead Way. I'll summarize the basics of the Boglehead investing strategy as concisely as I can. The 3-fund portfolio is the pride and joy of this community, and I refer to their version as the traditional 3-fund portfolio. If you've seen my other videos, you'll know that I roll with a modern 3-fund portfolio that is quite different, but we'll get into that later in the video. Let's stay on course. The traditional 3-fund portfolio is made up of the following 3 holdings. And I roll with the ETF versions, but there are also index funds for the same thing. There's the US Total Stock Market, VTI, and this is usually the largest holding. And then there's the International Stock Market, VXUS, and finally the US Total Bond Market, BND. The amount that you allocate in your portfolio to each of those holdings will depend on factors such as your age, risk tolerance, current wealth, your retirement goals, and your work situation. You'll need to do your own research to see what allocation mix makes sense for you, but this is the general 3-fund portfolio that the Bogleheads live and die by. And there are countless studies that show that this 3-fund portfolio consistently outperforms individual stock pickers and actively managed funds. The traditional 3-fund portfolio is well diversified. It holds everything with literally zero overlap. It's extremely tax efficient and it keeps the fees very low. It has put up objectively better results than 90% of the alternatives out there for many decades. If you want a portfolio where you can set it and forget it and only have to mess around with it for about an hour, if that, each year, so you can adjust your allocations based on your age, it's hard to beat the 3-fund portfolio, full stop. With that said, let's talk about beating the 3-fund portfolio. My mistake. Before we dive into the data, I would love to share one of my stupid mistakes with you. Much like Jack Bogle, I was always looking for ways to beat the market. I love reading his history before he created index investing. I'm a lot like him, only the dumber version. When I got my greedy fingers on my first 401k that I rolled over, I immediately put it into the best performing mutual funds over the last 1, 3, 5, and 10 years. These funds were actively managed with high fees, and I was buying at the top. This is before I knew that, generally speaking, last year's winners are next year's losers. But my spreadsheet was elaborate, and I cracked the code. The code of losing about $10,000 compared to the market, that is. I continued to learn more about how this stuff worked, a lot of that thanks to the Boglehead community, and I finally landed on owning VU, SCHD, and VGT instead of these actively managed high-cost mutual funds. The problem with Bogleheads. I'm a huge advocate for analyzing past performance to see how a collection of decisions have played out and how the macro has affected things, and that's another thing I share in common with Jack. I have developed a low-cost, passively managed portfolio that has outperformed the market and the 3-fund portfolio for each of the last 10 years. And the key factor in this one is that we're talking about each year, 8 of them being up and 2 of them being down, because any good portfolio needs that downside protection. This is important because one extreme growth year can make a portfolio look better than it really is over a certain stretch of time. Think about Kathy Wood and her actively managed ETF, ARK-K. My modern 3-fund portfolio actually has better downside protection for when the hot sector, such as tech, is struggling a little bit, and we'll dive into those details later. And just to point out, I actually invest in this modern 3-fund portfolio that has actually outperformed the market over the last decade. If you tell a Boglehead that, they'll give you a lecture on performance chasing, which in their defense, usually makes a lot of sense. But all this stuff I'm going to share is not just a simple what if. This has actually gotten my portfolio to 7 figures over the last few years. And I like that disclaimer because I see so many people saying like, well, yeah, if you would have bought a bunch of Bitcoin 10 years ago, you'd now be worth $19.8 billion. But did you buy a lot of Bitcoin 10 years ago, or are you just using past performance and hindsight to share this opinion? And this is just me coming to the Bogleheads' defense. It is extremely easy to beat the market in hindsight. Mr. Bogle liked to point out that the power of compound is magical, and I agree with them. And it works both ways. Each percentage point that you beat the market by or lose to the market by over a prolonged period of time disproportionately will increase or decrease your portfolio. The backtest and future strategy. I would like to point out a couple details before we dive into the backtest. I roll with the ETF VGT as my growth ETF within my portfolio, and I'm aware that that comes with some serious risk. Unlike the S&P 500 or VOO or the NASDAQ 100 QQQ, VGT will not automatically update its sector weightings as sectors come and go. I fully admit that I'm a long-term tech bull, and I don't really worry about the short-term fluctuations. I'm a buy and hold tech investor, and just to be crystal clear, I believe in the future of technology. What's done is done in the past, and that no longer matters for my holdings right here, right now. However, there is a more balanced version of my modern 3-fund portfolio that I would probably recommend to more people, especially someone that wants to buy and hold and not be quite as active with assessing their portfolio. And that is replacing VGT with QQQM, the NASDAQ 100. The NASDAQ 100 is still tech heavy, but it does update its sector because it's the largest 100 companies within the NASDAQ. And as trends change, much like the S&P 500, it'll automatically grab the next 100 largest companies. The backtest that I'm about to show will show both versions of the modern 3-fund portfolio, along with one of the more flattering versions of the Boglehead 3-fund portfolio. I'm not going to dock the subset of Bogleheads that are disproportionately higher on international stocks and bonds. And again, it's using a little bit of hindsight, but I'm going to use more of the US equities because I believe the majority of the community, from what I've seen over the years, likes that 80-20 mix of US versus international. Let's see what we get. We're out on Portfolio Visualizer, where I like to run my backtest. In this scenario, we'll take a look at the last 10 years. We're going to start with 2014 and go through 2023. Now these numbers, the initial amount and the contribution amount, are just to roughly mimic my portfolio and timing. We have 100,000 initial amount, that's from a 401k, and we're going to contribute $32.50 a month, reinvest dividends on, and we have 3 portfolios here. We have the modern 3-fund portfolio with VGT. We have the modern 3-fund portfolio with QQQ instead of VGT. This is the one I recommend to the masses. This is the one I recommend to tech bulls. And then we have the Boglehead 3-fund. So for portfolio 1, we have a third of VOO, VGT, and SCHD. On portfolio 2, we have a third of VOO, QQQ, and SCHD. And then for the Boglehead, I did an 80-20 split of US and international stocks. So we have a total of 72% VTI, the US total market. We have 18% VX US to get an 80-20 ratio. And then I just added in 10% bonds. So I went pretty light on these compared to what a lot of Bogleheads think. And that's just because VTI has performed better. So I'm trying to give a good aggressive mix for the 3-fund. Sometimes people go with VT, which has done worse. Sometimes people bump this up to 40% or this up to 50% depending on age. I'm giving a favorable backtest for the 3-fund portfolio. So when we hit analyze here, let's see what we have. With the modern portfolio with VGT, we end with 1.25 million. This is about my portfolio right now. With the modern portfolio with QQQ, we end with almost 1.2 million. So not that much less, and possibly worth it over the years and in the future for less tech exposure. And then for the Boglehead 3-fund portfolio, we end with $884,000. You'll notice here that the best year is the highest performing with the modern VGT, which we would expect. But you'll also notice the worst year is the best with VGT. You have a higher Sharpe and Sortino ratio, which will show that it has a better risk-adjusted return than the Boglehead portfolio. And then the market correlation between all of them is basically 1. You'll see here by the portfolio growth that the modern portfolios just slowly pull away with similar trend lines. The market goes up and down, generally speaking, at the same time. It's just the extremity of the ups and the downs depending on your portfolio mix. Here's where it gets pretty wild. When you look year by year, you see that the blue bar is my modern portfolio and the yellow here is the Boglehead 3 fund. Every single year, not just overall, but every single year, the blue bar has outperformed the yellow bar. We get that downside protection here of SCHD, where the yellow bar lacks that. And same concept in 2022 when tech really took a nosedive, including VGT, which was down here somewhere. We have that downside protection of SCHD. Even in a bad year, you outperformed the 3 fund portfolio. But yeah, year by year, you're just getting outperformance, not only on high years, but also on bad years. Up through last year, you see, and last year, QQQ actually outperformed VGT, as you can see. But the 3 fund falls short yet again. Let's take a look at the annualized returns. Over the last 3 years, we've been 11.2% with the modern portfolio and about 6.2% with the Boglehead portfolio. Over the last 5 years, we have an impressive 18.7% with the modern portfolio and 12.36% with the Boglehead 3 fund. And then over the last 10 years, which is also the full, because we just did a 10-year stretch, 14.5% growth with the modern portfolio compared to 9.23% with the 3 fund. 5% when you throw it into compound does some wild things over the years. See, in the past results are past results, and that's where people always accuse of performance chasing. But what's underrated about the modern portfolio is its elite downside protection, with a third of it being dividend-paying value-based companies that will go down a lot less than everything else in the modern portfolios and most of the stuff in the 3 fund portfolio. It's extremely underrated downside protection. I know the rebuttal will be performance chasing and watch out for reversion to the mean. And I agree that there will always be some form of reversion to the mean long term. And I think that the modern 3 fund portfolio has very similar downside protection to the Boglehead portfolio. As for the international exposure, I fall on Team Jack on this one. I'm willing to be a little late to the party, and I know eventually times will change, and I will probably jump in a little bit late. But I'll make hundreds of thousands, if not millions of dollars in the meantime over the years as it compounds. And this is exactly where Jack Bogle fell with the international party, and he was right. He says some of that could have been luck, but I agree with his views on the US market moving forward in the future. And I also agree that that could change, and when it does, I will adjust, probably slightly too late. The overarching point here is that the core values and the methodology of the 3 fund portfolio are sound, but the limbing mentality has led the group to extremes, and it's lost them hundreds of thousands, if not millions of dollars in their portfolios. I think the group needs to adapt, be a little more open-minded, and just loosen up a little bit. You can't even bounce passively managed low-cost ideas that deviate from the exact indexing strategy on the forums anymore. If you do, they look at you like a guy with a can full of gas and a handful of matches rushing into their village. I'll see you all here next year to report on how 2024 went. And if things went terribly, it might be everyone's turn to laugh at me. If you're one of the 9 people watching, first of all, thank you. And second of all, check out this video right here to see just how powerful the VGT SCHD mix can be over time in any portfolio. Thank you for watching, and I will see you here each and every Thursday and normally on a Sunday. Peace.